Welcome back to Xrpproce. We are Cosmic Wajchinskine, where complex finance and crypto narratives are broken down into clear, simple ideas that anyone can understand. Today's discussion centers around one of the boldest claims circulating in the digital asset space right now, the idea that XRP could reach $100 in a relatively short time frame. This claim has gained attention after comments from Jake Claver, a well-known voice in institutional crypto discussions, who expressed extreme confidence in that number. Instead of reacting emotionally or taking the statement at face value, this analysis focuses on why such claims are being made, what structural changes are happening behind the scenes, and how institutions are actually thinking about digital assets like XRP. The crypto market has always been full of strong predictions. Big numbers generate attention, clicks, and debate. But predictions alone are never the real story. The real story lives underneath them, in infrastructure, regulation, liquidity, and adoption. That is exactly where this breakdown begins. Jake Claver's comments did not come out of nowhere. They are rooted in changes taking place within traditional finance, particularly around settlement systems, real-time liquidity, and the gradual shift from speculation toward utility-driven crypto use cases. One of the most important ideas discussed is the role of clarity in regulation within the United States. Unlike many digital assets, XRP is often described as having more legal and structural clarity compared to most of the crypto market. This matters because large financial institutions do not move based on hype. They move when rules are clear enough to reduce legal and operational risk. Until systems like the proposed Clarity Act are fully in place, institutions remain cautious. However, even before complete clarity, conversations are already happening around using blockchain-based assets for back-end settlement infrastructure. A major moment referenced is the acknowledgement from leadership connected to traditional exchanges, including NASDAQ, that distributed ledger technology is likely to be used first on the back end of financial markets. This is not about replacing stock trading screens or retail platforms. It is about settling trades faster, reconciling data more efficiently, and reducing friction inside systems like the DTCC. This is where XRP enters the conversation, not as a speculative token, but as a potential liquidity and settlement layer that already operates at speed and scale. The crypto market most people are familiar with is driven by volatility. Prices rise quickly, prices crash hard, and cycles repeat. That behavior is largely fueled by speculation, leverage, and short-term positioning. What Claver and others are pointing toward is a different phase of the market, one where sustained liquidity and continuous institutional volume begin to stabilize price behavior. Bitcoin ETFs are often used as an example here. Once large-scale buy and sell flows exist on both sides, price swings become less extreme and more structured. The argument being made is not just that XRP's price could rise, but that if an asset reaches a certain level of liquidity and trust, it could remain there because it is actively used, not just traded. In that scenario, price becomes less about hype and more about function. Settlement assets behave differently from speculative assets. If an asset is being used daily to move large amounts of value, it naturally develops a level of price support through consistent volume. To understand why price targets like $100 even enter the conversation, it is necessary to understand how markets behave before and after institutional liquidity arrives. Most of crypto's history has existed in a low liquidity environment. Prices have been driven by emotion, speculation, leverage, and short-term narratives. That is why markets repeatedly experience sharp run-ups followed by aggressive drawdowns. This behavior is not a flaw unique to crypto. It is what happens in any emerging market where real utility has not yet fully scaled. When liquidity is thin, large players, often referred to as whales, can move prices dramatically with relatively small actions. Add leverage on top of that, and volatility amplifies. This is why crypto markets feel chaotic during speculative cycles. However, once consistent institutional participation arrives, market structure begins to change. Volume becomes deeper, bid and ask spreads tighten, and price swings become more controlled. This is the transition some analysts believe XRP may be approaching. The comparison to Bitcoin ETFs is important. Since the introduction of ETF products, Bitcoin has experienced a noticeable reduction in extreme volatility compared to earlier cycles. This is not because Bitcoin suddenly became less risky, but because large pools of capital now provide ongoing buy and sell pressure. When an asset has sustained two-sided flow, no single participant can easily dominate price action. This is how mature markets behave. In the context of XRP, the claim is that once liquidity reaches a certain threshold, the asset can begin to function as a settlement instrument rather than a speculative trade. Settlement assets require stability. Financial institutions do not want unpredictable price swings when moving value in real time. They want liquidity, speed, and reliability. If XRP is used as a bridge asset in settlement processes, consistent volume itself becomes a stabilizing force. This is where the discussion around a potential price floor begins. In traditional markets, commodities and currencies often establish price ranges based on usage. When an asset becomes essential to economic activity, demand does not disappear during downturns. It becomes embedded into systems. The argument presented is that if XRP crosses a certain threshold and is actively used by institutions, its price behavior could permanently change. Another important layer here is correlation. Historically, altcoins follow Bitcoin. When Bitcoin rises, capital eventually rotates into other assets. When Bitcoin falls, liquidity drains quickly. This pattern exists because Bitcoin acts as the primary risk indicator for the crypto market. However, that correlation weakens when an asset develops independent utility. Gold, for example, does not move in lockstep with equities because it serves a different role. If XRP becomes infrastructure, its relevance goes beyond trading cycles. Market psychology also plays a role. When fear is high, retail participants often exit positions, creating opportunities for institutions to accumulate exposure at lower prices. This dynamic is not unique to crypto. It happens in every asset class. The difference is scale. Institutions move slowly, but when they commit, they do so in size. Their participation is often invisible at first, happening through custody, derivatives, or back-end integrations rather than direct public buying. Timing remains the most difficult variable. Markets do not move according to expectations or calendars. Even if the fundamentals are shifting, price may lag. This is why many long-term analysts focus less on short-term predictions and more on structural developments. Liquidity infrastructure, regulatory clarity, and enterprise integrations matter more than headlines. By understanding liquidity mechanics, one thing becomes clear. Price targets are not magic numbers. They are reflections of market structure. In the next part, the focus will move to global adoption, why regions outside the US matter, and how settlement use cases scale across borders. Now that we've explored XRP's partnerships and technology, it's important to understand how the market itself reacts and why liquidity plays a crucial role in price stability. In the crypto world, many people focus only on price predictions, but the real dynamics are driven by how buyers and sellers interact. Market psychology, the collective behavior of investors, can create extreme swings, especially in a highly speculative asset like XRP. Historically, XRP has experienced significant volatility. Prices can spike rapidly during hype or FOMO, followed by sharp drops when large holders sell or when market sentiment shifts. Jake Claver mentions that once digital assets like XRP reach a certain level of institutional adoption and liquidity, this volatility tends to decrease. Consistent buying and selling at scale helps stabilize prices, much like what we've seen with Bitcoin ETFs. Essentially, the more XRP is used and traded by institutions, the less extreme the price swings. Liquidity is a critical factor here. In simple terms, liquidity refers to how easily an asset can be bought or sold without affecting its price. High liquidity means large transactions won't drastically move the market, which is crucial for institutional use. XRP is building liquidity through partnerships with exchanges, banks, and global payment networks. Once institutions start using XRP for large-scale settlements, such as cross-border payments or back-end stock market transactions, the demand and usage will create a natural price floor, reducing the chances of extreme drops. Market sentiment also affects how retail and institutional investors react. Currently, the Fear and Greed Index shows that market participants are cautious. When the index is low, it often signals that retail investors are selling due to fear, which can create opportunities for long-term accumulation. Analysts like Claver highlight that timing is difficult, but understanding market psychology helps anticipate potential movements. For instance, if Bitcoin rises, altcoins like XRP often follow, as investors rotate their funds into other assets. Conversely, during risk-off periods, crypto prices can drop sharply. XRP's cycles are also influenced by macro factors like regulatory clarity, interest rates, and economic conditions. Regulatory developments in major economies, especially the US, have a strong impact on institutional confidence. Positive news, such as clearer crypto regulations, tends to encourage adoption and investment, while uncertainty can cause short-term sell-offs. Similarly, any large-scale liquidity injection or reversal in monetary policies can affect crypto prices. Therefore, XRP's market behavior isn't just about hype. It's a mix of investor psychology, institutional adoption, and external economic factors. Another important aspect is real-world usage. Once XRP is actively used to settle transactions, volatility may decrease even further. Unlike purely speculative coins, XRP's price could be supported by actual usage in payment networks, treasury operations, and cross-border settlements. This creates a scenario where price movements are tied more to transactional demand than pure speculation, which is critical for long-term growth. Finally, it's worth noting that predictions like $100 per XRP are not guaranteed, but they generate discussion and awareness. Analysts make these predictions to highlight potential outcomes, but the real takeaway is to understand the mechanisms that could drive adoption and stability. When XRP is integrated into institutional systems, supported by high liquidity and accepted globally, it may achieve sustainable growth even if extreme price targets take longer to reach. We'll explore how stablecoins and traditional financial companies are shaping the future of crypto and why XRP fits into this evolving ecosystem. Stablecoins are digital assets designed to maintain a stable value, often pegged to fiat currencies like the US dollar. Experts describe them as the Trojan horse of crypto because they bring users onto blockchain networks without exposing them to the typical price volatility of cryptocurrencies like Bitcoin or XRP. Once people use stablecoins for transactions, they often begin exploring other crypto assets, which naturally includes XRP due to its utility in fast and low-cost settlements. Companies like Western Union, a traditional money transfer giant, are beginning to adopt crypto-friendly strategies. The CEO recently confirmed that they are exploring on-ramps and off-ramps for stablecoins in different regions, such as South America and Africa. This means customers could convert local currency to crypto and back efficiently, improving speed, accessibility, and cost compared to traditional transfers. For XRP, this is significant because it positions the token as a settlement layer for large-scale cross-border payments. Unlike conventional systems that rely on intermediaries, XRP can transfer value directly between parties in near real time, which reduces fees and delays. Ripple's infrastructure further supports this trend. Tools like Ripple Prime for institutional liquidity and Palisade for secure digital asset custody make it easier for banks and enterprises to adopt XRP without worrying about operational risks. These solutions also strengthen confidence among large-scale investors and institutions. When financial companies see that XRP can reliably process transactions and integrate with existing systems, it becomes a practical tool, not just a speculative asset. This real-world utility is what differentiates XRP from many other altcoins. Stablecoins also complement XRP adoption by acting as a bridge. For example, someone sending a stablecoin payment internationally might settle the transaction using XRP on RippleNet. This combination allows for instantaneous, low-cost transfers even during off hours when traditional banking systems are closed. Over time, more users and institutions engaging with this system create consistent transactional volume, which helps stabilize XRP's price. Analysts suggest that as usage grows, XRP could form the backbone of many on-chain financial operations, extending from corporate treasuries to remittance services. Another factor driving adoption is regulatory clarity. For years, uncertainty around crypto regulations slowed institutional participation. Now, with clearer rules emerging in major markets like the United States, institutions can confidently integrate blockchain technology. This is visible in the increased engagement of companies like BlackRock and Vanguard, which are exploring crypto infrastructure investments. Their involvement adds liquidity and credibility to the market, making tools like XRP more widely accepted. Traditional financial systems are also under pressure to innovate. Legacy services like Western Union face declining market share because users can now move money faster, cheaper, and globally using blockchain and stablecoins. Ripple and XRP provide a solution that is not only competitive but future-proof, offering real-time settlement and transparent tracking of transactions. Analysts argue that in 5 to 10 years, companies that fail to adapt could lose relevance entirely. This is why Ripple's technology adoption matters. It's not just about crypto speculation, it's about transforming global payment infrastructure. Finally, XRP's role in this ecosystem goes beyond payments. Its potential integration with stablecoins and institutional tools could create a new financial layer where value moves seamlessly across borders. From treasury operations to retail and cross-border remittances, XRP provides a scalable and efficient alternative to traditional intermediaries. Combined with Ripple's ongoing partnerships and technological advancements, this positions XRP as a key player in the global financial system of the future, Ripple as a whole, and understand why many experts believe it could become a major player in the digital finance world. Ripple is not just a cryptocurrency company, it is building a comprehensive digital financial infrastructure that spans payments, settlements, custody, and treasury management. This broad approach positions Ripple as a potential leader in blockchain technology, comparable to how Amazon dominates e-commerce. One of Ripple's most significant offerings is G-Treasury and Enterprise Treasury Solutions. These systems allow businesses to manage liquidity, execute payments, and settle transactions efficiently using blockchain technology. By integrating XRP as a settlement layer, Ripple ensures that transfers are fast, secure, and cost-effective. The ability to provide real-time settlements is particularly important for global companies, where delays in cross-border payments can be costly and inefficient. Ripple also offers institutional liquidity and execution services through Ripple Prime. This platform enables large financial institutions to move significant amounts of digital assets securely and quickly. Meanwhile, Palisade, Ripple's custody solution, provides high-speed, secure storage for digital assets. Together, these tools make it possible for traditional financial institutions to adopt XRP without facing operational or security risks, which has historically been a barrier for adoption. Another major advantage for Ripple is its strategic acquisitions and expansion plans. Analysts predict that Ripple may continue acquiring complementary companies to strengthen its infrastructure. This could include firms in payment processing, treasury intelligence, or stablecoin technology. Each acquisition would add another layer of efficiency and capability, reinforcing Ripple's position as a central hub for digital financial operations. Over time, these developments could make Ripple the largest digital infrastructure company in the blockchain space, supporting both retail and institutional users worldwide. The impact of Ripple's growth goes beyond individual transactions. As institutions and businesses adopt XRP and RippleNet solutions, the token itself becomes embedded in the financial ecosystem, creating natural demand. For example, if XRP is used to settle portions of the US stock market or other global markets, this usage would support price stability and increase the asset's value proposition. It's not just about speculation anymore. XRP would have tangible utility in real-world financial operations, which is a major step forward for any cryptocurrency. Ripple's influence also extends to global adoption trends. Countries in Europe, Asia, the Middle East, Africa, and South America are actively exploring blockchain and digital finance solutions. XRP, with its speed, scalability, and low transaction costs, is well positioned to serve as a bridge currency across these regions. By facilitating efficient cross-border transactions and integrating with stablecoins, XRP could play a critical role in shaping the future of global finance. Finally, the long-term vision for Ripple is ambitious. Analysts suggest that if adoption continues at this pace, XRP and Ripple's infrastructure could support a digital economy worth trillions of dollars. This includes seamless value transfer across borders, integration with corporate treasury systems, and even potential back-end support for stock markets and payment networks. While short-term price predictions like $100 per XRP generate discussion, the broader focus should be on Ripple's role in building a global financial ecosystem. One of the key takeaways is that XRP is becoming a real-world financial tool. Its integration into projects like Project ION, partnerships with R3, and potential usage for back-end settlements of stock market trades show that Ripple is aiming for functional utility. Unlike many cryptocurrencies that exist purely for trading, XRP has tangible applications in cross-border payments, treasury operations, and institutional settlements. This functional use is what could provide long-term stability and adoption. Another important point is the role of institutional participation. Large financial players such as BlackRock, Vanguard, and Franklin Templeton are starting to explore blockchain technology and crypto investments. Their involvement brings liquidity, credibility, and confidence to the market. With consistent trading volume and high liquidity, XRP's volatility may decrease over time, creating a more stable environment for both retail and institutional users. Stablecoins also contribute to this ecosystem, acting as an entry point for people to start using digital assets on-chain. However, while there is significant potential, it's important to recognize challenges and risks. Market volatility remains a reality, especially in short-term trading cycles. Macro factors like interest rates, economic policy changes, and regulatory updates can impact crypto prices quickly. Additionally, traditional companies entering the blockchain space may face operational challenges or slow adoption. Even Ripple, despite its strong infrastructure, must continue innovating to maintain a competitive edge. Understanding these challenges helps set realistic expectations and emphasizes the importance of focusing on long-term trends rather than short-term price predictions. Looking forward, the future outlook for XRP is shaped by several trends. First, real-world adoption is likely to increase as more institutions and countries integrate blockchain solutions. This could position XRP as a key settlement layer for global financial transactions. Second, Ripple's ongoing technological expansion, including custody, liquidity solutions, and payment rails, strengthens its long-term potential. Third, as the digital economy grows and cross-border payments become faster and cheaper, XRP could see sustained demand, reinforcing its role in the ecosystem. It's also important to note that XRP's value is not solely dependent on speculative trading. The broader adoption of blockchain technology, integration with stablecoins, and real-world usage for payments create intrinsic value that goes beyond short-term market fluctuations. Analysts suggest that as this adoption increases, the market may begin to recognize XRP as a critical infrastructure asset, not just a cryptocurrency to buy and sell. Finally, while ambitious price targets like $100 per XRP generate excitement, the bigger story is Ripple's long-term impact on the financial system. The company is building a platform that could rival traditional financial networks, improve efficiency, and create new opportunities for cross-border commerce. By understanding the technology, adoption trends, and market dynamics, investors and observers can better appreciate XRP's potential without focusing solely on price hype. In conclusion, XRP and Ripple represent a transformative force in digital finance. From partnerships and real-world adoption to institutional integration and technological innovation, the pieces are coming together for a global financial ecosystem that moves faster, costs less, and reaches more people. While challenges remain, the long-term outlook is strong, and the next few years could redefine how value moves across borders. The story of XRP is still unfolding, and it's one to watch closely as digital finance continues to evolve.